analysis, plus take a quick look at one sector. Somebody sent me a note this morning and said, hey, can you please just tell me what the hell is going on in this sector? So we'll do that. Again, 9:30, market opens. You are someone else's exit liquidity. So you got to be aware of what's going on in the market. That's why we're going to be hanging out here for the next 25, 30 minutes, going through what actually is worth engaging and trading today, whether this market is safe. Look, we're at all-time highs. Momentum remains very strong. Liquidity remains ample. Guys, it's just pure momentum in this environment. And we're going to show where smart money is positioning today. Key macro, futures at records. Not shocking because we had that momentum switch take place back in April. Now everybody's just chasing. If you like the markets at 48.60, you're going to love them at 63.50. That is how quickly this market has completely rebounded. And keeping an eye on the SPY, keeping an eye on the Qs, the DI, and the index. We'll talk a little bit about how to utilize volume-weighted average price in just a moment. But the Genius Act is the story of the day. Once again, Trump signing the Genius Act on the 18th. This requires one-to-one backing for stable coins with cash and short-dated U.S. Treasuries. So they found a backdoor way to secure the U.S. dollar reserve system for just a little bit longer. What to watch? We're going to be watching reserve flows into and out of short-term treasuries. This is going to impact yields. This is going to impact liquidity. This is all very positive news because there is going to create this artificial demand, really artificial. I mean, it's real demand for short-term treasuries in the years ahead. Now, this is going to be interesting because this is not going to be implemented right away. It's important to keep that in mind. The rule is either 18 months after Trump signed it, so that puts you January 18, 2027, or 120 days after the regulations are written. Here's the fun part. Nothing gets done in Washington on time, so don't be shocked if we're like 90 days away next year from that implementation date, and they still haven't written half of it. Just once again, though, it's all about momentum. It's all about understanding how to trade some of these core tickers. And this is why I say keep a close eye on volume-weighted average price on Coinbase, Circle, and, of course, Strategy. We'll be watching Treasury ETFs, too, the SHV, T-bill, and Bill. Good to see you, Secret Agent Charlie. Good morning. And now the countdown begins. 10 days away from the implementation of tariffs on the EU and others. Commerce Secretary Lutnick confirming over the weekend that is a firm deadline. Of course, we might chicken out. Who knows? But Tesla will kick off earnings, followed by Alphabet, Intel, and Coca-Cola this week. Tesla will be the story. Once again, this is why we are doing the masterclass on Tesla. Big focus on margins, big focus on robo-taxi guidance, and obviously the impact of trade. Keeping a close eye on this broader story, Tesla, Google, Intel, KO, and the tariff exposure on names like U.S. Steel, Boeing, and Caterpillar. Broad momentum remains flat. Once again, in this environment, we have that kind of wall of worry focus. So if we look at the SPY and we look at the Mag 7, we are seeing strength here, but in the broad S&P 500, the 505 names, not the top 6, we are kind of evened out. So when this goes negative, we just turn around, we look at something called the FNGD. That is to help us understand whether or not there is leverage leaving the system, and right now there is not. We continue to see this wall of worry strength in the Mag 7. And with earnings in focus, the reality is, so long as capital remains robust in the system and we continue to see all of that increasing passive support, that money's going to continue to flow into these top names, into Tesla and Amazon and Alphabet and Meta and Apple. And we'll get some reaction. We're going to be talking about earnings. What is the optimal way to be trading this stuff? Well, we're going to be digging into volume-weighted average price and earnings reversals tomorrow morning. But I would just want you to keep a very close eye on that, simply because there's some weakness persisting. We can see it. What's strong right now? Open Door. Wow. I forgot that you were a thing, but Open Door, yeah, real estate, that's great. 175% after hedge fund shout out, but is the crash coming next? Yeah, probably. We'll probably see this thing turn right back around. RXRX has been a name in momentum that we've said every time that the LABU breaks above its 20-day moving average. RXRX how coming above its 200-day moving average. And if it could stay there, yes, this can take off very quickly. This is a heavily shorted stock, 35% float. And once again, the correlation is the LABU. So when we are above the 20-day moving average on the LABU, we are in RXRX. And this is a little bit stretched now, but big move coming from around 5 to around 6. This has obviously been on our watch list for a while. VSEC is weak. Netflix weak. Netflix did pretty well on last week, but had that post-market sell-off. And this is one of those things, post-earnings sell-off. And this is one of those things to keep a very close eye on as we head into earnings week, with a focus on Tesla and with a focus on Google, that yes, they can have good news and then they sell on the news. It can be very confusing to people to see this happen, particularly the first time. But remember, the purpose of the market is to what? Is to sell for the best price possible. And in this case, we saw some earnings, post-earnings selling. It wasn't bad, right? It was pretty good. And actually, you had multiple increases. You had groups like UBS and you had other banks raising their forecasts. Well, once again, people took that as an opportunity to sell and profit. Uber. One of those names that we have seen Gianni talk about on a regular basis and was on top of that huge move up. And we got up to nearly $100 and we've been kind of dipping. This is one of those names that we want to keep a very close eye on 30-minute and 1 hour charts. And if we get into oversold territory, the RFI and the MFI, it becomes one of those buy the dip, strong momentum names. I believe Gianni says that there still is upside here on Uber. Once again, weakness becomes strength pretty quickly. ASML, one of the companies that I absolutely love for the long term, very weak. Continuing to break down. I'm going to keep a very close eye on the RSI and MFI. If we get into oversold levels on this stock, what I will then do is look to sell a put spread and try to get a better price because this is something that I want to own for the long term. ASML is a natural monopoly and really the only company in the foundry business. We have given this company an incredible amount of work in the future to prevent them from going to other nations. And once again, if we get into these oversold periods, what I do at that point is start looking down under that 700 level, maybe even all the way down to the 650 level. And I'm trying to pick the price I'm willing to pay. In the event that it never meets that point, I collect premium. That's simply trading a put spread, selling a put spread. But if this market breaks down and ASML blows through it, I would rather lose to the downside than be buying it here and see persistent weakness. So just a different type of strategy. We'll dig a little bit deeper into selling put spreads actually tomorrow in the Theo Masterclass on Tesla, because that is going to become a valuable trade in the future if we do start to see some selling in that name. Watch list today, a lot of focus in China. Oh, China. VIPS, a lot of these names coming right back at that 20-day, 50-day moving average. And we talked about this last week in the Tesla Masterclass, the focus that when we see this convergence of the 20, the 50, and the 200-day moving averages, that typically sets us up for a powerful one-directional move. And in this case, it's starting to look, with China's ongoing support of its markets, that these names will see more focus to the upside than to the downside. If you're trading a name like this, you have natural stops built in right here at those moving averages. In addition to that, we're watching WEME. This was the name that I talked about on Friday. And once again, it just keeps continuing its short-term run. This is one of those names that with the short float right around 9.6% and some strength coming in, it just continues to burn higher. And again, made that apology on Friday because it just kept popping up on the list. And sure enough, it just continued to run. Keep a very tight stop on WIMI. And WB back in focus once again. We've been digging into this name, but Weibo Corp, this is one of those momentum names that I continue to say every time it breaks above its 20-day moving average, it is cheap. It has a strong F score. It has a cheap gram score. This thing can run. And once again, just entering above that 20-day moving average and using the 20-day moving average as a stop. All right, which is going to bring us to the bigger conversation on momentum today and the names that are on breakout lists and the F and gram score. And I'm going to momentarily go through the F and gram score stocks. We'll talk about 20-day moving averages. But real quick, I get a lot of emails. Holy cow. Like I woke up on Sunday morning and again, support at TheoTrade.com. Put my name in the subject line, but it was a lot yesterday. So somebody had sent me a note yesterday and then replied to something else that I wrote this morning about the Genius Act and asked if I could just talk about what's happening in the insurance industry. Okay, I know that this doesn't sound very exciting because I don't really even focus on the insurance industry that much. But it is important because this is the sector that's getting absolutely smoked. You knew it when you saw what was happening with UNH. And you don't need to sit around and try to pick the bottom of this. But it is important that you understand what you're specifically looking for when, I don't know, maybe in 6 months, when there actually is opportunity here. The healthcare sector, right, which is such a critical part of U.S. spending and U.S. markets, UNH obviously beaten up badly this year, but the healthcare sector is under pressure for a number of reasons that a lot of people don't dig too deep into. The core thing within insurance right now, and the XLV, which is the healthcare ticker, right? XLV. The weakness in healthcare has really been fueled by the pressure here. So Elements Health did not report, or did report, forgive me, Q2 2025 earnings, ELV. And oh boy, that did not end well. 884 per share, missing consensus of 920, and its benefit expense ratios increased 260 basis points year over year to nearly 89%. Basically, higher Medicare costs are impacting them in Medicaid and the Affordable Care Act health plans. So the stock gets crushed. This is happening across the entire sector. And a lot of people will be watching what's going on here and trying to figure out, well, what the hell do I do? Do I try to buy this dip? And the answer is no. Because these pressures are going to continue. The exact year-to-date figures for underperformance vary, but this fund is clearly lagging the broader market because of insurance costs. And even though it looks cheap, right? We go back to forward earnings, things along those lines. No, because the timeline for this is that there probably is not going to be recovery in this sector through at least 2026 to 2027 and possibly even longer. So how do you turn your focus to this? Do you even want to focus on this? Well, what's going to eventually happen are two things. And I know this because I've seen this happen multiple times over the last 15 years. These healthcare stocks can get cheaper. And what the companies will do is start to prioritize a variety of different things in order to strengthen the case for investing in them. And how do they do that? Well, they do that by improving something called their Graham score, a Piotrowski score. Okay, now let's take a little bit of a step back and let's talk about this process once again. Because in the world of finance, I didn't say finance, I said finance, much to my wife's detriment. The Joseph Piotrowski score was created by a University of Chicago professor. He's now at Stanford. And it's a 9-point scoring system to identify fundamentally strong value stocks. Now, does it matter that it's a value stock? Not really, but these old school value metrics still do matter, and they still do have a lot of, it's the reminder that the purpose of the entire equity markets, right? The purpose of a market is to sell, but the purpose of the equity markets is to attract investment capital. Full stop, right? So companies need to they need to fight for capital. And you see the misallocation that happens on a constant basis. As I've said, in the upstream oil and gas market, there are 32 names trading for less than their book value, which is insane. Because once again, those assets should just be purchased by an Exxon and just pump cash flow. But that's not what's happening. Anyway, F-score has 3 points, three particular elements to it. The first is profitability. So if your net income is above zero, if your operating cash flow is positive, if your return on assets is positive, if your cash flow is better than your net income, you get a point for each of those. Then there's leverage. And this is very important in an environment where we have seen these market crashes and we have seen runs on capital, runs on the dollar, and concerns about the stability of a large number of companies. So you want to focus on reducing your long-term debt. You get a point if you've done that. You get a point if you increase your current ratio year over year. And if you haven't issued new stocks, new shares, you haven't diluted your shareholders, you get a point. And then you have 2 more points. One around operating efficiency, higher gross margins, and higher asset turnovers. Okay, so you get a 0 to 9 score. You get a 7. That is strong. That's what we're looking for. Then you have the Graham model. Ben Graham, it's on the floor, sitting over there, haven't picked it up, and it's pretty much just holding the door open, but the intelligent investor. And this is Ben Graham's conservative stock valuation. This is a formula for what is known as intrinsic value. And the entire premise here is earnings per share times the PE ratio of a non-growth company, no growth company, 8.5, plus 2G, and the G is the expected annual earnings growth. So if the EPS is $5 and growth is 6%, the value is 5 times 8.5 plus 2 times X. And that will give you a number suggesting, hey, this stock is worth up to $102.50 that I would be willing to pay for it. Now, this is important because he emphasizes low PE ratios, low price to book value, strong current ratio, stability in the earnings part, and that debt is less than the net current assets. All of this stuff still does matter in pockets of the market. It really doesn't matter at the top of the S&P 500. It really doesn't matter in a lot of the Magnificent Seven stocks. But at the end of the day, in a pure market, in a place where all of the insane incentives that have been created by crypto, by just momentum, this stuff still is out there, and it still creates unique possibilities for people because there's lower risk tied to some of these names if you are simply trading them around 20-day moving average. And what I'm saying is you're probably going to see some of the insurance companies eventually get to a strong F score and a lower Graham figure. That's going to be valuable, but you're going to have to wait. The 20-day EMA, I've talked about this before, technical indicator. I prefer it over the simple moving average because the weight of it is focused on the most recent price moves, where a 20-day SMA is the average of the last 20 days. The EMA puts a bigger focus on the weight of the most recent days compared to the end of the line in terms of the 20. So I believe it's 9.8% or 9.5% on the weight for the 20-day EMA, and then you move to about 8.7, and then you move all the way down to virtually nothing for that last day. But by focusing on recent prices, it helps us identify more short-term trends, and we're looking for breakouts and breakdowns based on that moving average. Crossovers of price or shorter EMA crossing than the 20 EMA signals positive trend. So what does that give us? Well, unfortunately, Uncle Stock, which I like to use, does not have the EMA. It has the SMA, and it's going to be close. So that's okay. But I do just want to point out that I have to do a little bit more work. So I'm going to pull up the F score, and I'm going to put that at least 7. I am going to remove financials because financials from valuations perspective are not what we want to be looking at with the Graham score. Instead, with the banking stocks, you want to be looking at price to tangible book value, totally different metric. And we're going to look at the Graham number, and we're going to put this at 0.8 because I want liquid names that I can trade options around. I'm going to set market capitalization to at least $500 million. Once again, the one thing that I have noted when it comes to these names is if an activist comes along and tries to force change, it's probably going to be above the $500 million line. The activist defense groups are not going to come in and protect a name like this under $500 million because they typically charge 1% fee, and that's a $5 million fee. So not really interested in that. And then the last thing that I want to add is just this one little metric. Okay, so I'm going to add that up. I'm going to show the conditions. I'm going to exclude the fuzzy values. I'm only focusing on U.S. stocks, U.S. listed stocks, and I am given this list. I left one thing out, made one error, but I will refine this. And the error that I made was simply not listing all of the stocks that hit that list. Okay. So now I have a list of high quality, cheap intrinsic value, and a note on where each is on its 20-day EMA, or forgive me, moving average, simple moving average. And by simply lining all of this up, I am now looking at the numbers and the names that are within the range of that 20-day because I'm looking for ongoing breakout reversions. So Taylor Morrison, TMHC, is on this list and is hovering right at its 20-day moving average. It's had a good little run, right? 58 took it up to 66, but now you are right at that line. And if you start to break down under this line, well, there becomes a natural, interesting trade to the short side because, again, some of these names are not just going to continue to break out. They will break down because they lose their momentum. What becomes the natural trade for THMC if it actually falls under this 20-day? It would be buying the call, or forgive me, buying the put right at the money and selling at the 50-day line. Simply looking for a move down and then a retest here, and then looking for another way to trade it to the upside if it can get back above that 20-day. This is all real stuff. The bulk of these companies own assets. They're real. Weibo's on this list, tech company. We've got GM here. We have Costamare, which is shipping, food in Fresh Del Monte, Tri Point Homes, Farmland Partners, interesting momentum name in GI Apparel. We've seen moves on that before. And I'm simply looking for breaks above these levels, particularly companies that join this list as well. When something shows up, it usually is because Something has been happening to that sector for a period of time, and we don't know when that sector is going to rebound, and we don't know when that sector is going to break out. But if you're looking to try to be a contrarian and you're looking for housing to be, really start to break out, we saw a lot of housing names popping up on 13Ds, on hedge fund sheets. We saw that happen back in Q2. So if you want to try to focus on this and try to call the bottom on something or look for a breakout, do it around these moving averages, because that's value, quality, and momentum. The value is in the gram, the quality is in the F score, and the momentum is in these breaks above the 20. Once again, very tight stops and looking for the rebounds to come as they do. But Taylor Morrison has been absolutely hammered. It's taken a bit of a big haircut since December. This is just a different way to reevaluate the stock. Can you share the presentation slides? Sure. Core thing here, just keep in mind, right, is you're also looking for momentum to return to the name. And as we've seen previously, we saw momentum and some of these indicators suggest positive momentum back here. Well, right now, the MACD has turned negative. We're still kind of moving toward a consolidation here in the ADX, and the RSI and the MFI are weakening. So even though it is on this list, even though it is cheap and has high quality, I'm actually looking for THMC to move lower if it breaks under that 20-day and retesting its 50. And we've seen it happen multiple times, obviously. And then we just wait. We try to find some time where it comes back above these moving averages. Let me make sure you didn't. Oh, okay. Thank you for making a copy of it, because we can't have people messing around with too much of our stuff. All right. So once again, I would anticipate that you're going to see some of these insurance names eventually get on this list, and that's going to be the time to start to analyze and assess whether a reversion and a rebound is coming for that sector, and it might take some time. All right, on to TradingView. I've talked a little bit about MFI, RSI, etc. in recent days, and we're looking at names that are breaking out. Once again, the screeners, pretty simplistic. People have been asking about this, so do me a favor. Just listen to my explanation, and please don't make me type this out 400 times. It's very tiring and repetitive to have to simply state, look, we're looking for a relative strength index that is over 48 and approaching 50. Same with the money flow index, over 48, approaching 50. We want to be over our EMA. We want to be over the 20-day. We want to have a MACD positive signal. We want to have a DMI. Directional. Yep. There you go. 1 day above. MACD positive crossover 1 day. Market cap over 100 million, which is still low, but it is what it is. Here's your names. APP, FLG, Wolf, Go. All of these stocks have just pushed above those key levels that we were looking for. So we keep tight stops on any of them that we're looking to trade. Now, a move of 45% or a move of 11% is definitely going to be too much to move on, right? But you do have a natural stop in at that 20-day moving average. If you look at some of these other names that have not moved much, but APP, is that AppLovin? Yep. AppLovin. Well, again, you got a baked-in stop here of around 350, and we're just looking for positive momentum to return to this name. This is a Gianni name. I could feel that. Breakdown, other side, same thing. Just flipping the numbers over. You're just looking at a breakdown on 52 on the RSI, 52 on the MFI, negative move on the MACD. Well, what's on that list? UPS. It's an interesting situation for UPS, obviously, given the trade news, but The real move here is back here at that 20-day 100, but I mean, you're not far away here. So compelling, broader macro story. Core weave. No, CRWV is not core weave. That is, no, it is core weave. Huh. Wow. That actually surprises me. Core weave breaking down a little bit. Big momentum move to start the year. KRG, GPI, EXPD. So you got a lot of tariff related names that are cracking under these three moving averages. And as I said, if you get under these lines, looking for a strong directional move in one direction, this could obviously be in trouble over the next couple of days. A lot of trade exposure. A lot of transportation names getting kicked around right now and moving under these key moving averages. Processing, health tech, even some energy minerals. EP, wow, haven't seen that name in a while. But pretty simple rules. Just following the transition and following the state of momentum and keeping very tight stops if going against the grain. Now, again, I typically don't like to short unless we see a negative momentum event. We are still very far away from that, it seems. We would need a liquidity event that would have to probably lock up some things in the broader market. But we're seeing weakness in that bottom half of the S&P 500. And if we go and we take just a real quick look at the screen, we analyze just what is happening in the broader market. Down on the month, down 5%. On the week, beta 1 to 2. And we need to be S&P 500. 5 names. Now, I could change this. I can remove the beta. And you're going to see Exxon pop up onto the list, and UNH, Molina. It's a lot of healthcare names. Healthcare is really getting beaten up. But over 1, 5 names. Everything else is relatively lower beta. But these are the ones that will move at a much faster pace, obviously. Current state of affairs. Broader market, again, same thing. Keep a very close eye on the SPY. Keep a very close eye on the SPXL. Because, as I've said repeatedly, the problems in the market it's very, very, very difficult to be bearish and to try to short the broader market when there is ample liquidity and ample capital in the system. And the introduction of this new law does create more capital and more liquidity and may actually provide some additional support to other periods, other durations of bonds, probably up into the 7-year period. And that's going to be bullish. That's going to be positive. We want to see bond prices. We want to see yields continue to decline. We don't want to be in a 5% situation like we were in late 2023 on the 10-year. That's why we broke down the way we did back then. And once again, nothing good happens in the market when the S&P 500 is under its 20 and its 50-day moving average. So if you are looking for the first sign of challenge, it's going to be under the 20-day. It's not going to be up here. It's very, very difficult to try to call the top. It's actually significantly easier to call the bottom because there's insider buying and there's a policy change that accommodates the market. There really isn't a core thing that has consistently been able to call the top of a market going back since COVID, because all you need is just more liquidity. All you need is more leverage. All you need is more money flowing into the system, and equity prices will rise even in the face of weakness at the bottom half of the S&P 500 and the Russell. So keep an eye on that at all times and watch the TNA as well. This is the Russell 2000. The Russell, because it is so U.S. centric, is typically the first thing that leads to broader issues in the market. If the TNA starts to break down, that's when we start to watch the S&P 500 to see if this is a bigger, more systemic event transpiring. It is good to be back. I am tired, but we are going to power through this day because that's what we do. Don't take any days off when it comes to the market. Guys, as usual, thank you so much for taking the time to join us today. I will be back at 12:30. Don's going to be up in about 10 minutes. He's going to throw some music on in a moment. And I am going to go, I don't know, maybe take a nap for 5 minutes. All right, everybody. I hope you're having a good day. Talk to you soon.